It was interesting to see what the makeup of the audience is, given that I know there are analysts here, there are managers, and there are investors. I'd like to see a little bit more reaction from the floor. This is, after all, your conference. These are a very experienced group of investors, people who are investing in listed private equity as part of their job. So please react with it. Let's not make this a sort of, one pony show just from the stage. Let's do it for the whole audience as well. And let's kick it off by asking a couple of questions of you. Now, first of all, should listed private equity form part of any diversified portfolio for return-seeking investors? Yes, no, or don't know. Please vote now. Well, that's encouraging, particularly encouraging because there aren't many unshores. But a second question as well, because this is an interesting one. Where should listed private equity sit in portfolios? Should it be in equities? Does it count as an alternative investment? Or should it be somewhere else? Should it, for example, have its own discrete sector? Please vote now. That's also interesting because I discussed this with the panel beforehand, and I would say that they don't entirely agree with the conclusion that private equity counts as an alternative. But that's up really for the panel to tell you about. I'm not going to introduce them. I'm going to let them introduce themselves, and actually for each of them to tell you a little about what they do and how they use private equity in their portfolios. And we'll start at the far end, please, and come along, Peter.
Good morning. Oxfordshire Pension Fund, where I'm the independent advisor, has got assets of £1.5 billion, and it's a defined benefit local government scheme. 6% of the assets, £90 million, invested in listed private equity, and a further 3% in unlisted fund of funds. 9% as a total is high for local government schemes. The average is between 4 and 5%. The fact that Oxfordshire has got positive cash flow year by year just from pension contributions, even before taking account of investment income, means it's not going to need to realise assets to pay pensions for a number of years, so it can afford to have this illiquidity in part of the portfolio. It began investing in listed private equity 20 years ago, 1993. Prior to that, it had a few holdings in what were then called venture capital funds, with mixed success. It wanted to increase its weight and diversify, and it raised its target to 2%, which in the mid-90s was quite a high figure, a very high figure for similar schemes. It continued to raise its exposure to private equity to 4% in 2005, 6%, and then 10% in 2009. But from 2007 onwards, most of the increase came from commitments and drawdowns to unlisted fund of funds. And indeed, future investment is likely to be through the unlisted avenue, partly because it's getting quite difficult to find liquid ways of getting into the listed market when we're already the size we are. Whenever the asset allocation has been increased to listed private equity, it's been a corresponding offset to the long-only equity target, because we see that as an alternative to equities. We don't want to skew the risk profile of the portfolio too much by adding listed onto ordinary equity. The geared exposure it gives has been very valuable in the last 4 years. The LPE portfolio has risen about 160% capital terms 4 years to March, against about 100% rise in the all share. Of course, that's helped by discounts coming back from over 60% and rising NAVs. The previous year to March 2009, of course, was a less happy experience. Somehow I seem to have mislaid the exact figures for it.
Max, you're with an asset manager. What sort of clients and how are you using private equity?
Yes, Max King. I'm at Investec Asset Management, managing multi-asset funds. We use private equity in all our multi-asset funds. Our allocations vary between 5% and 10%. The reason for using them is that they significantly extend the scope of equity investment. You're investing in a huge number of companies which otherwise are closed to you if you're an investor in listed assets. As that implies, we only invest in listed vehicles. We're not allowed to invest in unlisted at all. It's what we look for. We look for equity-like returns plus a premium. We expect listed private equity to give us equity returns plus, on average, 5% per annum. People call it risky. In general, risk is the price you pay for higher returns. We don't see listed private equity as more risky than general equities. Even in 2008, when on some private equity listed vehicles dropped very sharply in value, at the same time you would have lost a great deal more if you invested in the so-called safe assets like the banks. So we don't see it as significantly more risky, and we think that in recent years the model has been de-risked quite substantially. We would like to have a broader spread of companies to invest in. We are very much stock pickers, and we've disliked quite intensely 3i since about 2009, and now we merely think it's a bit expensive. So we'd like to see some more vehicles come out, and it's a complete mystery to me, for example, why no one has suggested that Lloyds Bank spins out Lloyds private equity, an excellent business, and we'd very much like to invest in that directly. And it seems that the government wants Lloyds to divest of just about anything apart from the one differentiated business which really doesn't belong in there at all. So we'd like to see that business spun out, but we'd like to see a broader range of offerings. And if we did have that broader range, then we would be able, in some of our larger funds, to increase our allocation. So we're very positive. We don't worry too much about discounts. Discounts are an opportunity, not a threat. And in some cases, of course, discounts are a warning. Some of the funds with the highest discounts have been pretty poor performers. We do use all types of listed private equity. We have the funds of funds, particularly Pantheon. We have the hybrids, Electra. We have the direct investors, HG Capital. What we'd like to see, though, is we've seen a lot of disposals recently. We'd like to see some good new investments. And it's been a little bit disappointing that the private equity businesses haven't found more new investments in the last 12 months than they have. It's disappointing, of course, though. We don't want to see them making bad new investments. We want to see them making good new investments. But we'd like to see more progress on the investment side without them acting as though the money was burning a hole in their pocket. Thank you.
I imagine you've got a rather different type of client base.
Yes, at Rathbone Investment Management, we look after 20 billion of assets on behalf of private clients, trusts, charities, and increasingly SIP portfolios. Being private clients and SIPs, because private clients have a habit of dying or moving or divorcing and having to liquidate assets quickly, we tend to do all our private equity exposure through the listed vehicles. I'm responsible for researching and recommending private equity trusts to Rathbones, but I must be doing an extremely poor job because despite having 20 billion under management, I'm afraid to say we only have 0.5% in private equity. We very much think at Rathbones it makes up an equity part of the portfolio, and some of us, me included obviously, believe it should be a part of any diversified portfolio. But I think the horrors of 2008 have frightened the private client community into being very slow to come back to this sector. Of course, those that have had fantastic returns over the last 3 to 4 years. But despite a chief executive who sits on as a non-executive of Graphite, a retired chairman who's on the board of HG, and a current chairman who is a private equity man himself, we are very slow to convince the private client community at Rathbones that private equity does have a place in every diversified portfolio. I think as far as risk is concerned, whether it's a high risk, low risk or medium risk client, it can make up part of your equity allocation, be that 30%, 50% or 70%. And so I think it fits into low risk, medium risk and high risk clients. And I'm continuing to bang the drum, and many of you have come to see me, and we will try and broaden out the audience to increase our exposure to private equity.
Chris, as a representative of a family office, I imagine you've had more of an involvement with private equity than the average private client.
Yes, although we cover both sides of the coin, actually, because we're a hybrid business ourselves. We have the family office looking after the Guinness family assets. Lord Ivor is the head of the Guinness family. And that historically has tended to be LP, to get into private equity. But we also, for the past 5 years, have been managing multi-asset funds. And the concept there, quite simply, is that we take family office style portfolios and replicate them in UCITS funds. So clearly there's a need for a private equity allocation there, which, because of the liquidity requirements, has to be listed. Interestingly, 5-6 years ago, we stopped investing in LPs, and that was mainly a cyclical call at the time. It seemed like it was getting quite overcooked, and the assumption was that we would start reallocating to LPs, when the cycle turned. And in fact, we haven't really done that. And the reason is that we've in fact used listed private equity for the family office clients as well. Few reasons behind that. The loss of control of cash flows in LPs is quite a big issue, and LP structures generally, and not just in private equity, you see them in property and the like as well. It's the same issue. And the fact that if you don't like the direction which the LP is going in, there's really nothing you can do about that. The accounting issues which go alongside managing LP investments is quite a headache, and performance measurement and attribution, and all too often you end up really just relying on the general partners telling you how much money they've made for you. It's difficult to track. And last but not least, when we came back to it, then the fact that the listed sector was at a substantial discount. Why would you invest at par when you can invest with good managers at a discount in the market? So the combination of all those things actually means that our by choice, both sides of our business have gravitated towards listed private equity. And I've felt for the past year, and I still feel it, despite the fact that performance has picked up in the sector of late, that it's still got some quite significant potential from here, just looking out cyclically from here. We do view, where we have it in our funds business, we do view private equity as an asset class, a sub-asset class, basically. That's really where we focus, what you would probably recognize as sub-asset class level. So we identify 20 asset classes at that level, one of which is private equity. Our allocations do tend to come out for growthy types of portfolios of between 5 and 8%, batting around that sort of level. And we look to populate that, which we primarily do through a sort of core and satellite approach. So we'll have our core managers, the ones we really know and trust, the long-term holds, and with the satellite ones perhaps be a bit more opportunistic, primarily motivated by valuation and value. So that's really the approach. And I think for the industry, this is, I would suggest, one of the challenges, which is getting people to accept private equity as an asset class within a diversified portfolio. I have a problem with the term alternative, because I don't know what it means, and I think it can lead people down the wrong path if it seems to imply that there's some difference in correlation, which there clearly isn't. It's a sub-asset class, but it sits alongside public equity for us. So when we go up an asset class level, it's part of our equity allocation. I think that's the way it has to be seen. But it does have valuable attributes, and we do, from our modelling, we believe it does play a useful role in boosting risk-adjusted returns at the portfolio level. And I think the challenge for the industry is to get past this, get people to... The reason why the LP private equity industry got so big was because it was the asset allocators who made that top-down decision to allocate to private equity, and that's what made the industry so rich there. And we need to possibly get that point across and past into private client portfolios, because as long as people keep viewing them as stocks, it's going to be a struggle, because they're going to compete with all the other stockbrokers' ideas for a place in the portfolio. Anyway, I've probably said enough there. I'll leave it at that.
Max, Tim and Chris have already said that they would not put private equity in alternatives, but think it's more allied to equities. Are you of that view as well?
Yes, and I rather agree with Chris. We don't always know what alternatives are, and I think it's sometimes convenient to pretend that certain types of investments are a diversified and uncorrelated asset class, but actually the reality is private equity is just as the name implies. It's an equity, and particularly if it's a listed equity, it's very hard to argue that it's anything else. We do invest in alternatives, it's just that private equity is not something we classify in that space.
There's one thing came out of the last panel, which I would like to put to the panel here, which was the concept that private equity is not viewed as an income-producing asset by investors. And I'm just wondering whether the panel takes the same view. I mean, so what's a local authority perspective, for example? Are they looking for a return from private equity through dividends or just through growth?
I think the predominant return is going to be through growth, and dividends, although nice to receive, are not an essential part of the return because there's plenty of income coming in from the other parts of the portfolio. So if a listed private equity firm has a low or nil dividend, that wouldn't be a reason to shun it. It really is not an essential return for us, provided the capital comes through.
Tim, how about your clients?
I think in growth portfolios, it's extremely attractive in SIPs, in charities, obviously for some trusts that require income. But it shouldn't be seen as it's a growth stock, and you are getting some of that return back as income, and that's how it should be viewed. But I think that the great thing is, with the listed private equity space as it is today, you've got a choice. You can there are some very good funds out there that are returning capital to shareholders as income, and if that suits your particular client. For our particular clients, that's very attractive. If you just want to be for capital growth purposes, there are plenty of trusts out there where the income isn't a priority and isn't paid out. So I think there's choice, and our investors, again, it varies from time to time.
Well, this is a good opportunity to have the audience to work a bit. Just before I take the questions down, I'm delighted here, let's get a general question to the audience, one more based broadly on this whole concept of whether or not dividend income is important. So if there is a company in which you're invested, which is trading at a persistent and significant discount, would you as an investor rather have a dividend of 4% each year, the equivalent of 4% per annum in share buyback, so as Max has said, enhancing the NAV, or neither of those things? Please vote now. Well, that suggests that the audience, at any rate, is predominantly interested in capital growth. Now, we have some questions here, two people. I believe that there are microphones. If one of you could put your hand up, if we could take the question, please.
Hi, Dice McCann from Which Investment Trust. I just wondered what importance you put to assessing the remuneration models used. And if it's very important, how much money the management's put into the vehicles, and how they are, if it's their own money or if it's money that they've gotten from remuneration.
That's a good question. If somebody hadn't asked it, I would have had to have asked it. I don't know who wants to kick off with that. Peter, perhaps, or Tim. You obviously got a strong view on this.
Well, no, I did see a presentation from a private equity manager that came in last week that showed the sort of the growth in NAV, and then the rather large negative box that showed the provision for carry. I mean, I think private equity managers, if they're producing returns, and I think in any investment, in any walk of life almost, you pay fees to managers you want to support, to people you're prepared to give money to, and I think if the remuneration justifies the return, or the return, justifies the remuneration, we're happy to pay it.
Peter, do you have a view on remuneration?
We don't analyse remuneration closely, but if it's based on a traditional private equity model of a hurdle and a carry, then we feel it's payment for results. So it's not an issue for us.
Yeah, if the performance is good, you don't look under the bonnet too much at the costs. But if the performance is poor, then of course fees become a factor. And a few years back, then the costs of running 3i were a major factor, but that was only because they performed so poorly. And people said, why are we spending 5% of NAV every year to run a fund which is not performing? So the primary consideration is good performance.
I would, may not be the right place to say this, but I mean, I think that I think the fees across the industry have been on the high side and under the pressure, and it's true in the hedge fund space as well, that people are beginning to question some of these structures. But I think the more specific thing is ideally I'd like to see some more consideration, a different treatment for leverage, to try and get a bit more sophisticated about digging out what the alpha really is. Obviously very happy to pay good rewards for genuine alpha, but when actually the component of the return which is attributed to leverage beta, I then start to wonder whether quite so much of that should go back to the GPs.
There was another question over there. If we could have the microphone, please.
Thank you. Jeremy Beckwith from London Wall Partners. Given that everybody seems to agree that private equity is really equity, what reason is there for expecting a premium return to equity markets? Is it that these companies have a higher return on equity? Is it that they're better at managing their capital? Is it that the managers are just smarter at finding growth stocks? Why should we fundamentally expect higher returns from private equity than from listed equity?
That's an interesting question. Which one of the panel would like to tackle that first? Max?
Well, the first starting point is, as Andrew Liebers showed earlier, because historically they have. That is the long-term record, and it's really, he's probably the best person to give you that answer. But I think the arguments are fairly cogent. It is that actually they have a better financing. A part of that's leverage, a better mix of capital and equity capital and debt. I think it's more active management. It's that actually anyone who buys a private equity, makes a private equity investment, is doing it for a specific reason. So it's got a clear strategy. It's not just sort of pottering along from year to year. And I think all those things tend to enhance returns. That people are targeting private equity for the most active parts of the investment universe. But the primary consideration, of course, is the fact that historically it has, and I think there is that you're probably best checking that with the managers themselves, because all I'm doing is giving you a second-hand answer.
Yes, Tim.
Yeah, I mean, if you consider a long-only concentrated portfolio of, say, 25 stocks, and you consider a private equity trust direct investment with 20 stocks, and you think how well the investment manager actually knows the underlying companies, I would say that the private equity manager would have done a lot more due diligence on his holdings than the public equity manager, and therefore, amongst everything that Andrew showed us on his initial chart, you can see that the returns from private equity are unsurprisingly better than, over the longer term, better than the public equity markets.
Chris, you're keeping private equity rather separate from equities in your asset allocation. Are you looking for more for it, and if so, why?
Sort of. I mean, they're a sidecar, really. No, I don't think it takes a great leap of imagination to see why they should be on. Certainly, those who are, have the really good track records, why they shouldn't be at least on par or even premium ratings. And it's all about mindset, really. The performance is there, so why is it not being recognised? And I think it does come down to mindset. If you turn the equation around and say, well, actually, what these things are really there to do is to give you very expert sort of exposure to vibrant parts of the economy, be they vibrant sectors, also a size bias, being able to invest in smaller companies with a small cap effect at your back in the hands of skilled managers. That's a great proposition, I would say, which in many other contexts people would see as something worth at least paying par for, if not a premium. And so I think there's still just these barriers of perception which need to be overcome.
And Peter, what about from the
Well, I think it's Max has mentioned some of the factors, but I think the key thing is that the direct private equity investor has control over the management of his investee companies, rather than an investor who is a passive shareholder in a wide range of bigger companies whose policies he can't influence. So I think it's this input into management, and in fact, changing management, changing financial structure, changing the business in the ways we saw in an earlier graph. That's what the private equity managers bring to it.
And I might just, it made me think that just as a quick supplemental, one of the, I don't really do stock picking anymore, but when I did as the UK equities manager, one of the great frustration is this rather perverse index which you're living with, and that there would be whole sectors which you just can't get exposure to in the UK through public equity, but potentially through these sorts of managers you can through that much more concentrated exposure, and things, for instance, like healthcare and the like, where you can get a much purer exposure through these vehicles.
Actually, there's a question there. Let's take that question first.
Tony Smuhart, Atlantic Omnium. My question is, Max King mentioned that it was disappointing that there were not a large number of good investments being made. My question is normally in private equity, there's always a catalyst. People see a strategy and a plan. Is that because of the private equity side, where they don't, they don't have enough funding or money at the moment, which I doubt, or are there just not enough good opportunities out there? This is a topical question. What are the impression of the panel as to the opportunities that are out there at the right prices now?
Well, I think there are a number of reasons. Partly it's because actually the cycle hasn't particularly favoured private equity. There's a lot going on in the venture capital space, and that hasn't really progressed to the growth capital phase of private equity. I think it's also the case that there's a lot of sort of lame ducks being kept alive by the banks, that actually what these businesses need is to be passed on to the private equity people to try and see what they can do with it, come up with a growth plan, improve the management, cut costs, embark on a new strategy. I think there's also to an element that time has moved on, and in the past a very good source of deals for private equity was spin-offs from larger companies. And I think actually that over the years, many of the larger companies have rationalized their businesses and focused much more, and there aren't these spin-offs which were so significant once upon a time. But I think that, with patience, banks will divest their businesses. I think that we'll see some of these sort of venture capital businesses, which are a large number, they will move on to the private equity stage of growth capital. So I would expect some sort of pickup in the deals in the next couple of years. And I think actually all the private equity managers are hoping for that.
Yeah, I think if you listen to Emma and Peter beforehand on the previous panel, they were highlighting some good opportunities that are out there as less capital is going to be chasing deals in the future, which will give private equity some good opportunities going forward. And if you look at the multiples that were mentioned, they are cheaper than public equities, particularly in the US.
We're coming towards the end of this session. I want to ask one more question to the panel, and perhaps we'll start with you, Peter, and then come down. Max actually said that one of the things he would like to see in the course of the next year is Lloyds Bank selling off its private equity arm. I'm just wondering that as investors, as people advising investors, is there anything you'd like to see from the listed private equity sector over the course of the next year or so? I'd settle for superb performance.
Well, I was going to say the pat answer is good returns with NAV growth and smaller discounts. I think if there were new companies coming to the market, new strategies, it is a relatively small pool of companies to choose from. I mean, I say that when you look at the wider range of equity companies. And I think if there were some new companies coming to market, that would ginger up the sector and give us more alternatives.
Thank you, Peter. Max, briefly?
In addition to the idea of seeing more deals, more new investments, and also seeing hopefully Lloyds Private Equity being an independent company, the other area I'd focus on would be that investors in the last year have started to look forward in the property sector. So property companies in the UK generally are trading not on the basis of historic NAVs, which are looking backwards, but on the basis of projections to the future. And I think in the private equity space that we talk about discounts to NAV, but we forget that these discounts, these NAVs are looking backwards, and that actually it's pretty rare to see a private equity company selling a business on at book NAV or at a discount to NAV. So I think investors should be looking forward rather than backwards, as they do in the property sector, and that would suggest better valuations. But that will take time.
Tim.
Yes, I think one of the big problems back in sort of 2007, 8, 9 was gearing on gearing at trust level, and I think thankfully that seems to be a thing of the past. And I'd like to continue, and balance sheet management again was something that terrified us private investors when overcommitments got completely out of control. And I think more of the same on the managing of the balance sheet, and hopefully no more sort of gearing on gearing that is needed in this sector.
And finally, Chris.
I think I would like to see some really aggressive action taken by some of the entities which are on big discounts. I think a no-holds-barred sort of approach to that, because I think they're holding back the whole pack. It was we made our views known to 3i a year ago that was the sort of approach which management needed to take, and I think we are getting that with 3i, and you've seen the effect that can have. So other management really taking that completely seriously and recognising that, look, you don't have a raison d'etre if you're sitting on a 30 or 40% discount. It's as simple as that. But then again, we don't want the sector just shrinking. So ideally, it would be nice to see perhaps some form of consolidation as well, but I don't think that will happen.
Before we thank our panel, I just want to finish with 3 quick questions for you, the audience. You've been listening to 4 seasoned investors. So let's start with asking you, are you currently invested in listed private equity? Yes or no? Vote now. Well, that's encouraging. The other 24%, you better get out there with your checkbooks. Question number 2, in the coming year, do you intend to add to your listed private equity holdings, lessen them, or just leave them unchanged? Please vote now. Well, that's very encouraging. 93% aren't going to be sellers. That must be good for the market. And finally, from what you've heard in this morning's session so far, how do you expect listed private equity to perform over the next 5 years relative to other equities? Outperform, underperform, or you don't know? Please vote now. Well, I would hope so too. Thank you very much. Thank you for participating as an audience, and a particular thank you to our panel for sharing their experience with us.